Right, chapter 10, sample example problems. This chapter, we are looking at the accounting for property, plant, and equipment. These are long-term assets that a company purchases, and they intend to hold on and use those assets for at least the next year beyond. That's why we call them long-term, because the company is not buying these assets with the intent to resell them. They are purchasing these assets with the intent to hold onto them and use them to help their operations. So this first problem we're going to look at, we are working with Trudy Company. They incurred the following costs. We need to indicate which account Trudy would record each of these costs. Okay. Now, one overriding concept you want to keep in mind when we're working through this problem is when we purchase a long-term asset, property, plant, and equipment, the cost that we record into wherever we incur a cost to purchase the long-term asset, we are going to record it as part of the cost. So even if it's not specifically a cost of the purchase, if it is a cost of purchasing the asset and getting it in place and ready for use, it is still a cost of the asset, okay? So I'll kind of hit that as we go through this problem. The first one, sales tax on factory machine purchase. Okay, so we purchased a factory machine and we paid the purchase price. But in addition to that, we also had to pay the sales tax. Sales tax is an additional cost of purchasing that factory machinery. So we would record it along with the purchase price into the factory machinery asset account. Painting of and lettering on the truck immediately upon purchase. So we had purchased the truck, recorded it as an asset, and to get the truck ready for its intended use, we had to paint and letter on our company's symbols or something, $700. So that is going to be added to the cost of the truck in the truck asset account because it's a cost of getting the asset purchased, in place, and ready for its intended use. Installation and testing of the factory machinery. We had purchased factory machinery and we had to install it and test it before we could use it. That is an additional cost of getting the asset in place and ready for use over and above the cost of the machinery itself. So that is added to the factory machinery asset account. Real estate broker's commission on the land purchased. We purchased land, we had to pay the broker's commission. So that is an additional cost of purchasing the land. That $3,500 will be added to the cost of the land in the land asset account. Insurance premium paid for the first year's insurance on a new truck. $880 is not a cost of purchasing the new truck, getting it in place and ready for use. This is just essentially a cost that we are incurring because we operate our business using trucks. So it's just a business cost. So we are prepaying a future business cost. That will just be recorded in the asset prepaid insurance account. Cost of landscaping on the property purchased. We purchased land or property and we had to landscape it before we could use it for its intended use. So the cost of landscaping is an additional cost. But instead of recording that in with the land, we keep track of any improvements to land in a separate long-term asset account. So it will go in land improvements. And the reason we have to separate out land separately from land improvements is because land is not a depreciable asset, okay? Because depreciation is the cost of the asset as it is used up, or the using up the value of that asset. But we will never use up land because land has an unlimited life. However, the land improvements do have a limited life, and we do have to depreciate those because land improvements won't last forever. Land does, okay? It's the same thing with number 7, cost of paving a parking lot for a new building constructed. The cost of paving the parking lot is not a cost of the land that was purchased. It's a cost of the parking lot, okay? It's a land improvement. And because the parking lot has a limited life, we record that separately from the land. So it will be recorded as a land improvement as well. Right? The eighth one, cost of clearing, draining, and filling the land. So when we purchased the land, before we could actually do anything with it, we had to clear it, drain it, and fill it. So it's not an improvement to the land, it's just working with the land. So we're not adding anything to it, we're just working with the land itself. So that will be recorded in the land account. Architect's fees on a self-constructed building. Okay, we built our own building and we recorded all their building costs as part of the cost of the building. And the architect's fees are another cost of constructing the building. So that will be added to the cost of the building as well. Okay. Again, the overall writing concept for all of this is any costs we incur to purchase an asset, get it in place and ready for its intended use, all becomes a part of the cost. So we have to add it to the appropriate asset account. Okay, our next problem is going to have us working with the accounting for an asset after it was purchased. So once we purchase the asset and we start using it, we are going to be using up some of the value of that asset. So Kelm Company purchased a new machine on October 1st of 2010 at a cost of $120,000. The company estimated that the machine will have a salvage value of $12,000. The machine is expected to be used for 10,000 working hours during its 5-year life. We are going to be computing the depreciation expense under these methods. Now, depreciation expense is not a loss in value. Okay, depreciation expense in the accounting world is the cost of the asset that was used up to help earn a revenue. We are using this new machine to help us earn revenues. So as those machines are helping us earn revenues, we have to record a little bit of its original cost as an expense in the period we used it. And that's what depreciation expense is. So under the straight line method, the formula to calculate depreciation under the straight line method is to take the original cost of the asset, subtract out any salvage value, sometimes called residual value, which is what the asset will be worth at the end of its life. So we're assuming that management estimates when we're done using the machine, we can sell it off for parts and pieces for $12,000. So if we take the cost of the asset, subtract out its salvage value or residual value, and then we divide by the number of years of life. Cost minus the salvage value divided by the useful life. This asset will be depreciated $21,600 per year. The great thing about the straight line method is that depreciation expense is straight. It's a straight amount every year over the life of the asset. So if we calculate $21,600 per year, it's going to be $21,600 every year for 5 years under the straight line method. Okay. Now, the one tricky part about this is that we purchased this new machine on October 1st. The $21,600 is the annual depreciation. But because we only owned this asset for 3 months out of the year, we need to take that annual depreciation and multiply it by the fraction of the year. That means for 2010, we will only record depreciation expense of $5,400. The journal entry to record the depreciation expense will be a debit to depreciation expense to record the cost or the value of the asset that was used, the expense incurred, and we will credit accumulated depreciation. Accumulated depreciation is a contra asset account. It is keeping track of how much of this particular equipment value has been used up. So at the end of year 1, we have depreciated at $5,400, and we have accumulated depreciation of $5,400 on the equipment, meaning $5,400 of the original cost of $120 has now been used up to help earn revenues. Now, this problem isn't having us do it, but let's figure out what the journal entry would be for the second year, for 2011. 2011, we will be owning and using the asset for the entire year, which means the entire year's depreciation would be recorded in 2011. So the journal entry at the end of 2011 would be the same. Debit depreciation expense, credit accumulated depreciation, but it would be for a full year's depreciation of $21,600. Okay. All right, using same information, same machine, let's use the units of activity method to calculate the year's depreciation expense for 2010. Under the units of activity depreciation method, we are going to take 2 steps to calculate depreciation expense. Okay, those 2 steps are to first figure out what the depreciation rate is per unit. Now, this machine, they're measuring its life not only in years, but in hours. So this machine is expected to be used for 10,000 working hours during the 5-year life. So the activity that they are measuring this machine by is hours. Okay. So the formula for the first step of the units of activity method is to take the original cost of the asset, subtract out its residual value or salvage value. But instead of dividing by the number of years of life, as we did in the straight line method, we are dividing by the total number of hours we expect this thing to produce over its life. That means that we are going to be depreciating this machine $10.80 for every hour it's used. Okay, that's the depreciation rate per unit for the units of activity method. The second step is, now that we have this rate per unit, each year we are going to multiply the year's number of hours. In 2010, the machine was used for 1,700 hours. We will multiply the number of hours times the depreciation rate per unit. That means for 2010, depreciation would be $18,360. The journal entry to record that 2010 depreciation would be the same journal entry as it was for the straight line method. We would debit depreciation expense and credit accumulated depreciation, but we would use this amount, $18,360 of depreciation expense for the year. Okay. Notice that the journal entry is exactly the same. It's just the method we are using to calculate the amount of the depreciation is slightly changing. All right, the third method that companies can use to calculate depreciation for an accounting period is the declining balance method. Right? So the first step in the declining balance method is to figure out the declining balance rate. And we do that by taking 1 divided by the number of years of life. So here, this asset has a 5-year estimated life. That means 1/5 or 20% is depreciated under the straight line method. And the declining balance rate says double it, double the straight line rate. So 1/5 or 20% times 2 means the double declining or the declining balance rate is 40%. In order to calculate each year's depreciation, we end up taking the value of the asset, the book value of the asset at the beginning of the year. And the book value is the difference between its original cost and how much has been depreciated as of the beginning of the year. In 2010, this asset was purchased. It was a brand new asset. So its book value at the beginning of the year is $120,000. At the end of 2010, there is 0 accumulated depreciation because we hadn't depreciated it yet. There's been no depreciation recorded to date. So the overall book value, when we go to depreciate it at the end of 2010, is $120,000. We multiply that book value by the declining balance rate of 40%, that gives us $48,000. Okay, now that would be the amount of depreciation if we had used this asset for a full year. But remember, this asset was purchased in October, so only 3/12 of it was used. Okay, 3 months out of 12 years. Sorry, 3 months out of 12 months. 3/12 of a year, or 1 quarter. So we're going to multiply the annual depreciation by the fraction of the year to figure out we are only going to record $12,000 of depreciation this year. So the journal entry would be to debit depreciation expense and credit accumulated depreciation for $12,000. At the end of 2010, that means the asset's book value would have fallen to $108,000. Okay? That is the difference between its original cost and its accumulated depreciation. When we depreciated it $12,000 at the end of 2010, we recorded the amount of depreciation into the accumulated depreciation account. So its balance is $12,000 at the end of 2010. That means when we begin 2011, the asset's book value is now $108,000. To get 2011's depreciation expense, we will multiply 2011's beginning book value by the declining balance rate of 40% to get that year's depreciation expense. That was used a full year, so we do not need to get a fraction of the annual depreciation. The journal entry would be a debit to depreciation expense of $43,200 and a credit to accumulated depreciation of $43,200. What that would end up doing is bringing our accumulated depreciation from last year's ending balance of $12,000. It would increase it $43,200 for the amount of depreciation we recorded at the end of 2011, bringing our accumulated depreciation up to $55,200. What ends up happening to the book value at the end of 2011 is it falls to $64,800, which is the difference between the original cost and its accumulated depreciation, $64,800. Okay, so here are the journal entries for those last two methods down below. Okay. In this last problem, we are going to look at how we account for the eventual disposal of assets when we're done using them. We are looking at selected transactions for Gene Company for 2010. On June 30th, we sold a computer that was purchased on January 1st, 2007. The computer cost $30,000. It had a useful life of 5 years with no salvage value. The computer was sold for $10,500. Then on December 31st, we discarded a delivery truck we had purchased back in 2006. The truck cost $40,000. Was depreciated based on a 6-year useful life with a $4,000 salvage value. Okay, so they want us to prepare journal entries for these. In order to first record the disposal or the selling of the computer, the first step is we need to update the depreciation because we sold this computer halfway through 2010. But we used that computer for January 1st through June 30th. The last time we would have recorded depreciation expense was at the end of 2009. Okay, because remember, these are adjusting entries for depreciation done at the end of every accounting period. So first step, let's update the depreciation expense. Now this was a straight line. This company uses all straight line depreciation. So let's figure out how much we need to depreciate under the straight line method. The formula is to take the asset's cost, which is $30,000. It had no salvage value or no residual value estimated. That means we don't have to subtract out any residual or salvage value. So the cost and then we divide by the number of years of life. So this formula is a little strange. They are essentially dividing by 5. Okay, that would give us $6,000. 6,000 is a full year's depreciation. We are only depreciating for half of a year, or 6 months. So we multiply the annual depreciation by half of a year. Gives us depreciation for this 6-month period of $3,000. So we debit depreciation expense and credit accumulated depreciation for $3,000. Okay. That will update the depreciation through June 30th, the date that we sold it. Okay. Now let's figure out how much we would have depreciated this thing since we bought it. We purchased it in 2007, which means we used it for all of 2007, 2008, and 2009. We've used it for 3 years so far. That means we would have had 3 years worth of depreciation since we bought that computer. Okay. Remember that depreciation is $6,000 per year, which is the cost minus the salvage value divided by 5. Okay. And this formula is probably a little difficult to read, so let's update it so that it's a little bit easier to read. I think that's easier to read. Okay. So if we take the annual depreciation of 6,000 and multiply it by the 3 years we depreciated it prior to 2010, we would have accumulated depreciation of 18,000. Then we just recorded another $3,000 worth of depreciation, which means the accumulated depreciation would be up to $21,000. Okay. Now, when we sell this thing, we need to completely get it off of our general ledger. Okay. That means we need to decrease the asset for what was originally recorded. So we are going to credit the computer for $30,000. It's sold, we no longer have it, we're decreasing the asset. If we no longer have the computer, we no longer need the accumulated depreciation account, so we can debit accumulated depreciation for its balance. Recall we figured out its accumulated depreciation would have been $21,000. We also received cash of $10,500 when we sold it, so we are debiting cash to increase it. So debit cash, debit accumulated depreciation, and credit the computer. Increasing cash, decreasing accumulated depreciation, and decreasing the computer. At that point, our journal entry is imbalanced because our total debits right here total $31,500, but our total credits are only $30,000. There's a $1,500 difference. When we stop and think about it, we received cash of $10,500 for an asset that was worth $30,000 less $21,000 in accumulated depreciation, or $9,000. So let me go ahead and make it a little bit easier to see. But the asset's book value is going to be equal to its original cost minus its accumulated depreciation. It has a book value at the date of disposal, $9,000. That means that we have a gain of $1,500 because we sold an asset that was worth $9,000 to us and we received cash of $10,500. We have a gain. Now, we haven't really worked with gains before, but a gain is essentially like a revenue. If we have a gain, we've increased our net income because we sold an asset for more than what it was worth to us. Gains and revenues act the same. They both cause our income to increase. They both have credit balances. Okay. The only reason we don't record that as a revenue is because it's not part of the normal course of business. We don't normally sell off our long-term assets. So we record gains for non-routine things like this, non-routine revenues. whereas revenues are routine revenues earned through the normal course of business. Okay, so let's do the same thing and let's record the discarded delivery truck. So we discarded it, which means we just tossed it. We didn't sell it. We didn't do anything with it. We got rid of it. Okay, took it to the junkyard. So first thing we need to do is update its depreciation, because the last time we depreciated it was the end of 2009. We discarded it at the end of 2010. So the depreciation under straight line is to take the asset's cost of $40,000, subtract out its salvage value, 40,000 minus 4,000, and then we divide by the number of years of useful life. Divide by 6. And here they multiplied by 1/6, which does the same. Okay, so 2010's depreciation on the truck will be debit depreciation expense for 6,000, credit accumulated depreciation on the truck for 6,000. Now that we have the depreciation updated, let's update our accumulated depreciation. And so the updated accumulated depreciation would be the annual depreciation of $6,000 on this truck, and we have used it since 2006. So we used it 2006, 2007, 2008, and 2009, and 2010. So we used it for 5 years, which means we have total accumulated depreciation of $30,000 on the date that we go to sell this truck. Okay. So when we we didn't sell it, we just tossed it. If we no longer have the truck, we need to decrease the asset account for its original cost of $40,000. So we credit the asset. We will debit accumulated depreciation to get rid of it, because if we no longer have the asset, we no longer need its contra asset account. At this point, we had a truck that had a book value on the date of disposal of original cost of 40 minus its accumulated depreciation has a book value of $10,000. Now, if we throw something away that has a value to us of $10,000, it's going to be a loss. Okay, so we will debit an account titled loss on disposal. That makes our journal entry balance. Okay. Losses, again, similar to how gains are just like revenues, they increase our net income. Losses are just like expenses. They both have debit balances and they both cause our income to go down. Okay. Losses are another cost that we incurred while doing business, but they're not normal routine costs. So they act like expenses, but they're not routine, and so we call them something different. We call them a loss on disposal. Okay. All right. I hope this all makes sense. Please reach out with any questions.